Here's what's coming up on Retirement Talk with Sandy Morris.
This day and time, a lot of people can call themselves financial advisors, and I think even people with like an insurance license can call themselves a financial advisor.
Hey, Sandy, we have a great show today. In fact, it's part one of a two-part series entitled, What Are Mutual Funds? We're going to get deep into it today.
If we're one of these individuals who you've got a lot of money in IRAs or 401ks, you might need to do some pre-tax planning before you get close to retirement so you can come up with a plan so that when you are retired and you need money, you're not constantly adjusting up into that higher tax bracket.
And now the host of Retirement Talk, Sandy Morris.
Welcome to the show today. We have 30 minutes worth of action-packed information designed specifically for you. So stay with us. Retirement Talk starts right here, right now.
Hi, everybody, and welcome to this week's Retirement True or False. I am accompanied, as usual, by Sandy and Steve. How you guys doing?
Doing great.
Really good.
All right, let's get started. My first question will be to you, Sandy, and that is, all financial advisors are created equal, true or false?
That would be false, Mark. All financial advisors are definitely not created equal. You have financial advisors that, well, this day and time, a lot of people can call themselves financial advisors, and I think even people with like an insurance license can call themselves a financial advisor. But a financial advisor is a true financial advisor. If you have a true financial advisor, you have financial advisors that help people grow their money, and they don't really understand how to transition into retirement and get it to last for the rest of your life. You have financial advisors that are good for just specializing in retirement, which is what Steve and I do. And I don't want to grow somebody's money. I'm a conservative person. I don't want to go out there and swing the fence and try to get those 12-15% returns. If I lost somebody money, I would just be devastated. So I'm a retirement financial advisor. I specialize in conservation and distribution and that kind of financial advice, and definitely not hedge funds and growing your money and stuff like that.
And I know, Sandy, you have a special designation. What is that?
It's called a registered investment advisor.
And what is that?
A registered investment advisor is a fiduciary, which means that you have to put your client's best interest at heart at first. And you would think everybody would do that. I always thought people, all my life, I always thought when you go to somebody and they tell you about your finances, they're going to tell you what's best for you. But that's not necessarily true. For instance, I had a gentleman in my office about a month ago, and he wanted to give me quite a few $100,000, like about $400,000, and he wanted me to grow his money in a specific amount of time. And I told him, I said, I don't do that. I don't need that pressure. You give me $400,000, you want me to grow it to here at this point in time? No, that's just not my area of expertise.
Gotcha.
I don't do that.
The term is just very loosely used now, Mark, financial advisor. To me, a financial advisor has several licenses and use a gamut of financial products. If you're one trick pony and you can only sell one product, then call yourself a product salesman, not a financial advisor.
Gotcha. All right, Steve, my next question is actually for you, and that is, if interest rates rise, then bonds could be the next big bubble where investors could get hurt. True or false?
That's absolutely true, Mark. And it's because of the relationship with interest rates and bonds. So if you don't know, it's got an inverse relationship. So as interest rates rise, the prices of bonds will fall. So, a few percentages of interest rates falling or rising could really cause a big decrease in your portfolio.
And there's also a difference between having bonds, Mark, and having bond mutual funds. Bonds, if you hold bonds to duration, you'll get your money back. If you have bond funds, there's no duration, there's no maturity date in there. So they're constantly being traded. So there's no guarantee of your getting your money back. And typically for every 1% that interest rates rise, your bond funds decrease 8%. So let's say interest rates rise 2%, you're looking at a 15 to 16% decrease in your account value.
And interest rates are at a historic low, are they not?
They are, but they're at a historic low, but even when they start to go up, you know, it's too late.
Exactly.
You're reactive instead of proactive. So there's some things that you can do, like get shorter term maturity dates and things like that. There's a lot of different things that you can use, like dividend paying stocks and things like that versus bonds right now. Bonds are just very volatile right now.
Thanks. And Sandy, my last question is for you. If you have already retired, then it's too late to get a second opinion about your portfolio. True or false?
False, false, false. I can't tell you how many people have come in my office, sat down in front of me, and wanted a second opinion and found out things that they had no idea. It's never too late to change and make things better. It's never too late, no matter how old you are. Taxes aren't going to go down, so if you can save money in taxes, you know, who cares if you're 65 or 68? If you can get a better return on your money and increase your safety and lower your fees, who cares if you're 64 or 69? Age doesn't matter.
The financial plans have to be tweaked all the time anyway, depending on, you know, what happens in your life. So it's never too late.
You know, retirement's not a place where you just get and set. Retirement is a continuous navigation.
Sandy, Steve, thanks so much. Stick around, folks. We got a lot of great stuff to come.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It's extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. Now, one way you can get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning, not someone who specializes in getting you to retirement, but someone who's dedicated to get you through your retirement. So if you don't have a clear retirement plan, then be one of the first 5 callers and you'll receive a free, complete planning review. There's no obligation and there's no cost if you've saved at least $250,000 for retirement. Here's what you'll receive: a free report to sort through your current advisor's costs, a tailored plan to guard your investments, a tax analysis to reduce the liability and increase your cash flow, and a custom income plan to boost your retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. SandyMorrisFinancial.com.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
Hey, Sandy, we have a great show today. In fact, it's part 1 of a 2-part series entitled What Are Mutual Funds? We're going to get deep into it today. So I'm going to start with you right now with the most basic of questions, because so many people, first of all, own mutual funds, and so many people have questions about the mutual funds they own. So let me start out by asking you, what exactly is a mutual fund?
That's an awesome question, Mark. And I'm not sure that everybody really knows, but I'll tell you. It's an investment account where it's compiled of a lot of stock companies or a lot of bond companies. And sometimes it's compiled of a little bit of both. So the reason why people use mutual funds is, number one, they have very low limits, meaning you could get in for a few $100s or a few $1,000s. And it diversifies the risk. So instead of putting your money into one stock company and that company going under, you can actually diversify and put it in several hundred companies or several hundred bond companies or whatever, and you can reduce your risks.
Why do you think they became so popular, Sandy? Because everyone's had one in their life who's got some money out there at some point, I imagine.
Yeah, I think they have. The reason they became so popular is because, let's face it, If you go to a bank and you want to open up a CD, you have to have a specific amount of money, a minimum. If you open up almost any account, they're going to have a minimum. And mutual funds is a conservative way for the most part back in the day, where you could take your money, you could put it in a mutual fund, you could get some growth, and you could do it for a few $100s, and there wasn't a minimum. So it gave the person who didn't have that much money a way to start investing in the stock market and grow their money.
Yeah, and they seem so simple as well. I don't need to know about this thing overseas or that happening over here. It just seems like a simple way to get a collection of stocks and bonds. Would you agree, Steve?
Absolutely, Mark.
And let me ask you this, because you and I were talking before the show got started today, and it was who's making money here? Because you would think that it's the investor who's putting their hard-earned dollars into the mutual fund, but that might not always be the case.
You're right, Mark. I mean, it's typically you would think that the investor would be the one that would profit the most, but there are actually three parties involved. One is the investment companies who build the mutual funds. You know, they get fees and expenses, administrative fees, expenses. Then you have the broker or the advisor who sells the funds, who's going to have commissions or fees as well. And then you, the investor, which you'll make money if the fund actually increases in value.
You know, I think it's a common misconception here because, man, I've been all around the country and I've spoken to advisors and they tell me all the time, and Sandy, tell me if I'm wrong here, that you'll get people to come in and they'll say, oh, no, my mutual funds don't have any fees.
Yes.
Is that ever the case?
Yeah, that's almost 100% of the case. If you have your more sophisticated investors, they know that they're paying some fees, but I hardly ever run into anybody that knows exactly what they're paying. I mean, you have all these internal costs, and when you get your statement, they're not on there. However, when you put your money in the mutual fund, you get this big, huge, thick prospectus, but I don't know that I've ever met anyone that's ever read it.
Oh, I love it. In fact, what I do is I keep it on my nightstand next to my bed, so if I can't fall asleep, I pick it up and 10 pages in, I'm snoring.
Yes, or they use it for kindling
Absolutely.
to start a fire or something
Exactly.
like that. Yeah.
Hey, all right, I've got another question here. Steve, let me throw this at you. Why are these costs not reported on mutual funds? Where are the costs reported? Because they got to report them somewhere, right?
Well, it's your bedtime reading, Mark.
That's right.
It's in the prospectus. I mean, that's where the share classes, whatever share class you buy, A, B, C, you'll see what the upfront or back-end fee would be, and then you have the expense ratios underneath, which are the administrative fees and costs and things like that charged by the company. And all that stuff is in the prospectus, but you just got to know where to find it.
I'll ask you one other thing that you're probably going to find in the prospectus as well, Steve, and that's I wanted you to tell me the difference between disclosed and undisclosed costs.
Along that same line is everything is disclosed inside the prospectus. So you got to read through it and find it. It's not going to be given to you readily by whoever sells you the
So you
mutual
can't
fund.
just look on your statement and say, oh, this cost me this. It's not itemized. It's probably not going to show on your
It
statement.
doesn't seem terribly fair, does it? That you get that big old statement every quarter on a
They
monthly
seem to think
basis.
it's fair, though.
Yeah. All right, everybody, stick around. You're watching Retirement Talk with Sandy Morris. We'll be right back after this.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. SandyMorrisFinancial.com.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
This week in the office, I had some clients actually come in that we had laid a retirement plan out for. And they had an interesting situation in that when they first came in, what he had done is he had put so much money in his 401k and pre-tax dollars account that when we were working with his retirement plan, we actually had to come up with a plan to get him some after-tax dollars saved. So when he was retired and he needed chunks of money for whatever reason, travel, roof on the house, do something to his boat, or for whatever reason, we weren't pulling money out of those pre-tax dollars and throwing him into a higher tax bracket. So we laid out the plan, and they've been clients for probably 2 years now. And they called the other day and said, Sandy, I need to come in because I'm ready to retire, and I've got a little challenge and I don't know what to do. So they came in, and the challenge is that when he retires, he's going to get this huge bonus, and he's going to get some severance, and he's wanting to retire now. But his salary is so high, if he retires now and takes that bonus now and takes his severance now, it's going to throw him in such a high tax bracket that it's going to take almost 40% of that back. To where if he did it next year, the year that he retired, then he wouldn't be in near the tax bracket. He'd be in like a 25% tax bracket. So we sat and we talked for a little while, and we came up with the plan that here's what he would do. He would put, based on the days that he had to do everything, he would give his notice. First of all, he was going to take his 8 weeks of vacation that he had coming. So that would buy almost 2 months. And then when he went back to work, he would give his notice, because he has to give it 30 days prior to when he's going to retire. And then he gets his severance and his bonus 45 days after he retires. So we decided for him to take the 8 weeks of vacation, and we decided the day that he was going to tell them that he retired. So the bonus and the severance comes in next year instead of this year. So literally saving him 13% in taxes instead of 25. He was going to pay like almost 39. So that saved him a ton of money. So if we're one of these individuals who you've got a lot of money in IRAs or 401ks, you might need to do some pre-tax planning before you get close to retirement, so you can come up with a plan so that when you are retired and you need money, you're not constantly adjusting up into that higher tax bracket. I came from a small town in Kentucky called Wickliffe, Kentucky, and it was down by where the Ohio and the Mississippi River meet. There was maybe a population of 1,200 or 1,500 when I was small. Had one red light. We had no money when I was little. I've been gone from home since I was 17 years old, and I didn't have anybody to depend on. So I've had to make what I've made, and I know what it's like to not have money. I know what it's like to have it and lose it. And I know those feelings that people have and those fears. I can feel that when they come in my office. It is a lot of responsibility. These are life-altering decisions that people are making. They're giving you their money, and they're trusting you to go put it somewhere to make sure that they're going to be safe and never run out of money as long as they live. And I guess I just did this naturally. And then when I really realized what I was doing, it was very humbling. All of my clients have my cell phone number, and literally I've said, if you are worried or something's keeping you up at night, I don't care if it's 1 o'clock in the morning, call me, because they need to have that certainty. And you know, I think people put their faith and trust in people that they get a good gut feeling for, and they feel like relates to their own situation. And I think you just have to get somebody that speaks your language or gives you that good feeling that you know no matter what, you can always call them, pick up the phone, and know what they're saying. They don't talk over your head. I've loved this business ever since I've gotten into it. I said when I found retirees and I got in this business, I found my people. The joy I get when I am able to help somebody feel safe or get certainty or get clarity, it's just the coolest thing. As long as they make a calculator big enough that I can see the numbers on it, I'm going to be doing what I do, because I can't imagine doing anything else. I love what I do.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It's extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. Now, one way you can get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning, not someone who specializes in getting you to retirement, but someone who's dedicated to get you through your retirement. So if you don't have a clear retirement plan, then be one of the first 5 callers and you'll receive a free, complete planning review. There's no obligation and there's no cost if you've saved at least $250,000 for retirement. Here's what you'll receive: a free report to sort through your current advisor's costs, a tailored plan to guard your investments, a tax analysis to reduce the liability and increase your cash flow, and a custom income plan to boost your retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
Welcome back. And now my colleague, best-selling author and financial advisor, Mr. Matt Dickin.
One of the most common questions that we get in the office all of the time, probably every single day, is individuals will ask us, how much am I paying in fees and expenses? And what am I paying all of these different fees and expenses for? So what I want to do with you here today is go through potentially all the different fees that can be charged on your investment accounts. Now, these expenses I'm going to go over with you, not everybody that's watching right now will be paying all of them, but in some cases you could be paying the majority of them. And then I'm going to walk you through a real quick example and show you what the impact of these types of fees can be over time. Now, again, it depends on exactly what you have your money invested in, but one of the things that we'll sometimes see is an advisory fee, or what's sometimes referred to as a wrap fee. And this is a fee that maybe an investor or an advisor or a brokerage firm might be charging you, and it's typically a percentage of whatever your account is worth. And that fee typically is going to be somewhere between 1% and 2% per year. And this particular fee is a lot of times a fee that you actually see on your statement. You know, we mention all the time that more often than not, fees and expenses can be hidden. You don't really know exactly what it is that you're paying. But this particular fee, a lot of times you'll see it on your statement. Now, one of the things you have to watch out for, though, let's say that you're paying someone an investment advisory fee or a wrap fee, and it's 1% or 2%, somewhere between there, but then they're turning around and investing your money in mutual funds. Well, then what you have to do is account for what the mutual funds are charging you as well. Every single mutual fund that's out there is going to have something that's called a management fee, and that's the fee that the mutual fund company charges you to manage your money. And once again, this management fee, more often than not, is somewhere between 1% and 2% per year. Right now, the national average for a management fee on a mutual fund is 1.5%. So a lot of times, if you see this particular fee on your statement, this particular fee, though, will not show up on your statement. It's a hidden cost. They take it directly out of your performance. Occasionally, we'll see something that's called an annual fee, and that could be a dollar amount or maybe a percentage. Typical percentage amount is 0.25%, but doesn't sound like a whole lot, right? But over time, especially if you're paying multiple fees, it can add up. Another fee that we'll sometimes see is an account fee. That, again, is about 0.25%, so 1/4%. This particular cost here, the turnover cost, this can get pretty costly, and this again specifically is something that's charged when you own a mutual fund. Turnover costs can be anywhere from maybe about 0.5% to maybe, believe it or not, as much as 5% per year. Now, the higher the turnover is on your mutual fund account, the higher this cost is going to be. What turnover is the buying and selling that takes place within the fund. So as the fund manager is buying and selling different stocks and bonds throughout the year, trying to increase the returns for you, that comes at a cost. That's not something that's free. Every time something that's bought or sold, there's a fee for it. And depending on the mutual fund that you might have money invested in right now, 0.5% is kind of on the low end. 5% would be very high, but it's somewhere between that range. Now, if you have something like a variable annuity, then a lot of times you're going to have an admin fee. And again, that's going to be typically somewhere around 0.5%. Mutual funds all have what's called a 12B1 fee, and that's just another word for commission. That's 0.25%. Some accounts will have an M&E cost or mortality and expense fee. That's usually about 1 to 3%. And then sometimes you'll have a rider fee on your account, and that again, that can be another 1 to 2%. Now again, most people are not paying all of these fees, but in most cases you're paying 2 or 3, in some cases 4 or more of some of these fees that are out there. So these are the types of fees that can be charged on your account. To put that into perspective, let's say that we have someone that has $100,000 invested in their portfolio. And let's say that they're paying some of these fees. Again, not typically paying all of them, but let's say that they're paying some of them. And let's say that the individual is paying about 3% per year, which is common. We see that all of the time. So again, the way it works, if you're paying 3% in fees, obviously that means that you're losing about $3,000 per year for whoever you're trusting your money to be with, for them to manage that money for you. And sometimes when someone looks at a fee like that, they say, well, that sounds like a lot of money. And then other times people say, well, I don't know, it doesn't sound so bad because you have to pay them something. The problem that I have with these types of fees is that over time it can become extremely costly. So if you're paying $3,000 per year on just a $100,000 account, think about what's lost, say, over a 10-year period. So if you're paying $3,000 per year over 10 years, obviously you could lose as much as $30,000 in fees on just a $100,000 account. Now, think about if you have $1 million in your portfolio and you're paying 3% per year, that means that you would be paying about $30,000 a year or $300,000 over a 10-year period. So you definitely want to, if you have any money invested in mutual funds, variable annuities, some sort of a investment account, you want to get your arms around exactly what your fees and expenses are, because they can add up pretty quickly. And obviously over time, there's going to be a dramatic impact on how much money you have to spend and enjoy in the future, or possibly how much money you have to pass on to heirs and beneficiaries. So if you have money invested in mutual funds, variable annuities, or stock brokerage accounts, and you're not sure how much you're paying in fees, we have a tool in the office called the Strategic Wealth Report. If you'd like to give us a call or request an appointment via our website, we can sit down with you, we can run the report and show you exactly, as a percentage amount and a dollar amount, exactly what you're paying and how much you're losing to fees and expenses each and every year. And then, of course, we'll try and find some ways to reduce or eliminate those costs.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? Will you be able to play with me?
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. SandyMorrisFinancial.com.
You're watching Retirement Talk with Sandy Morris, Tampa Bay's retirement television.
Thank you for watching our show today. And remember, if you have any questions, you can give our office a call or visit our website. And remember, you only retire once, so let's get it right the first time. We'll see you next week.